Most people think property investing is pretty easy. They think it's all about finding the best looking property they can find within their budget, because if they love it, then others will love it too. Nothing could be further from the truth. Quantifying property investments is an incredibly complicated business, and like all investments, should be purely about the mathematical outcomes. The very same property could have a vastly different mathematical outcome for you than it does for someone else. Let's first talk about the various types of property investment strategies out there. And whilst there's literally dozens of strategies that you'll see on the internet, they all broadly fit into just 4 different categories, being the flipper, the developer, the yield chaser, and the growth seeker. The flipper has a short-term investment view and is trying to buy property that's undervalued or distressed, looking to add a bit of value by renovating or decorating, then reselling to realise a quick profit. This is probably the most fun of all the strategies, particularly if you're a renovation show enthusiast. There are some people who have done very well out of this strategy, and some who even make a living out of it. But there's a number of hurdles the flipper needs to overcome in order to profit from his investment. Firstly, the cost of buying and selling a residential property in our capital cities is roughly about $50,000 once you've covered all the entry and exit costs. You'll then have to recover the renovation costs and holding costs. You also have to allow for the cost of your personal time and the opportunity cost of having all your equity tied up for the duration of the project. If you achieve this, you're then hit with full capital gains tax at your marginal tax rate, if you can realise a profit within the first 12 months. If you sell the property after 12 months, you will be entitled to the 50% capital gains tax exemption, unless you're deemed to be running a renovation business by the ATO. Doing all this and still making a profit is by no means impossible, but the upside needs to be a reflection of the risks taken on such a project. The main risks involved with flipping as a strategy are underestimating material and labour costs, obtaining council approvals, unforeseen structural defects, timeframe blowouts and the holding costs, and short-term negativity in property markets. All of these things can quickly eat up profits or cause substantial losses to the uninitiated. In my experience, when it comes to flipping properties, most profits are made in a rising property market where you would have made a good profit from a buy and hold strategy anyway, and not due to the flipper's superior design skills. Don't get me wrong, you can do well out of property flipping, but like anything, it's not until you gain experience and become really good at it before you can add genuine value. It's my opinion that this strategy should be reserved for the passionate few who can persist beyond the first few failures to eventually make a career out of it. As you'll see in Module 3 of this series, it's likely that you'll make more money by paying full price for good properties than you will by underpaying for inferior properties. For more detail on this subject, you can download the Ultimate Guide to Property Investment ebook by clicking on the link below. The developer is a bit like the flipper on steroids, but likes to build things from scratch. Property development can take on a few forms, from splitting residential blocks to building apartment complexes or developing larger scale land estates, or even using property options to secure future opportunities. With all property development, for every success story, there's also a horror story. Profits can be quite large, but developers need to deal with so many unexpected factors. Here's a few things that can go wrong: the weather, increases in labour costs and cost of materials, approval delays, disputes, hostile neighbours, changes in legislation, the solvency of builders and tradies, and even the interpretation of contract law. These things can all test the patience of experienced developers, and even the best developers are not immune to these contingencies. Suffice to say that some of the biggest and most successful property developers in Australia have gone bankrupt at least once. So it's certainly not for the faint-hearted. Property development can be a steep learning curve and requires deep pockets. For a detailed analysis of property development as a strategy, please refer to the full version of the Ultimate Guide to Property Investment ebook. Firstly, it's important to distinguish gross yield from net yield. The gross yield on a property is simply the rental return only, measured as a percentage of the value of the property. The net yield is the rental return less the ongoing expenses plus the tax add-backs as a percentage of the property value. This of course will change for investors with different financial circumstances and for different property types. Examples of properties with high gross yields are commercial, industrial and retail purpose buildings, serviced apartments, hostels and student accommodation. Retirees are one example of the type of investors we usually see seeking yield, as they often simply seeking a regular income stream and have no intention of ever selling the asset. Yield is also important though for those relying on rent to help meet the holding cost of the property, particularly when there's borrowing involved. The trick for most still accumulating wealth is to generate just enough yield to be able to hold on to not just one property, but a number of properties, while still focusing on long-term growth. This requires accurate cash flow modelling to explore a number of what-if scenarios. We'll cover this more in detail in part 2 of this series. Every property exists somewhere on the spectrum of high growth and low yield, or low growth and high yield. It's a bit of a trade-off. For example, as mentioned, commercial and industrial properties historically have a very high yield, but their growth is usually quite low. This is because their growth is a fair reflection of business and more closely follows the Consumer Price Index or CPI. Whereas luxury property, let's say that penthouse overlooking the water, tends to have much higher growth rates with much lower yields. Your standard residential property sits somewhere in the middle and has an advantage over many other asset classes because of an enormous pool of potential renters and buyers. Growth seekers are usually balancing the limited resources of both their equity and their cash flow in order to accumulate and hold as many growth assets for as long as possible. In Australia, growth seekers are rewarded the most by the tax office with income tax offsets that subsidise lower yields and capital gains tax concessions that reward the long-term investor. Most Australians that haven't yet retired and are still growing their wealth tend to be growth seekers. We'll delve deeper into exactly what growth investors are looking for in part 3. If you love the idea of replacing your current career with that of being a professional renovator or flipper, then go for it. I would never discourage anyone from following their dreams. And honestly, there are better people placed than I am to give advice in this area. I will say though, don't go into it with rose-coloured glasses. The reality TV shows are not reality. These amateurs featured on these shows are supported by large casts of professionals. From talking with investors over the last 25 years, I can say that most flippers find it very difficult to make any real gains from the first few projects they take on. As far as developers go, well, this is often the most profitable strategy in the short term if you get it right. And if you're lucky enough to have friends or family that are prepared to teach you everything they know or assist you with capital funding, then you'll definitely have a head start here. However, this strategy also carries the most amount of risk. Again, if you want to devote your life and career to it, you can be rewarded handsomely for your efforts. Otherwise, if it were that easy, everyone would be doing it. Property developing is not easy, and as in life, the high rewards require high amounts of stress and dedication.